Hi there. Welcome to another episode of Options Scenario Lab. I am your host, Gary Nudge, the Chief Options Expert at TanukiTrade. In Options Scenario Lab, the goal is to show you different option structures and strategies and how they behave differently in the same market environment. Right now, what we are looking at is the Amazon daily chart. And using the TanukiTrade GEX indicators, you can see that right now there is a 225 put support on the downside, this put support, and there's a 240 as a core resistance on the upside. There is also a core skew, which means that calls are more expensive than puts. So the market sentiment is a little bit bullish. And what I would like to target is the 250 at expiration of January 16. So this is the January 16 vertical line. That's the expiration line of January 16. And right now, what I would like to target is this 250, which is coincidentally the 8-8 pivot level of the MurrayMath. And right now, what you can see is from the GEX level that we are above the HVL at every expiry. So the price is above the high volatility level. We are in a positive GEX profile. And if Amazon reaches 250, which is the highest core resistance right now, that could create a core gamma squeeze and shoot the price higher. So looking at the Think or Swim Analyze tab, I would like to show you two different strategies which have the same underlying directional assumption, but with different structure. On the left side, you see a regular butterfly with 10 byte strike differences, which cost around $200 per contract. And this is like a normal butterfly targeting the 250. And on the right side, you see the same butterfly, but with a different configuration because the long lag is not 240, but 245. That's why it creates a broken wing butterfly for Amazon. And because it's a broken wing butterfly, there are many differences. Like the price is much cheaper, 0.32, which means $32 per contract. Remember, this is above $200. The regular butterfly have around 20 delta, directional delta, and this one is pretty flat delta. This one has higher positive theta. This theta is negative. So if you buy the regular butterfly structure, you pay more with a more directional bias, but time is working against you. If you buy the flat one, you pay less, but then the risk is transitioned to this side. So the risk is not eliminated, it's just transferred to this part of the spread. So if you think that Amazon will not shoot above 250, then this spread can create a much better risk to reward if you compare the debit as your primary risk or premium. But usually you have to compare this part of the spread because this is the maximum loss you can incur. So right now this has a very flat delta, and if the market gyrates back and forth and not shooting up straight to the 250, this would be a better trade probably, but we will see in the next coming days. If the market moves nowhere from here, so for example, if the market stalls around the 240 area, which is the core resistance, that's why it's important to see where the core resistance and put supports are, because those are potential reaction zones. So if the market stops here, then the regular butterfly will lose money because of negative theta. The broken wing butterfly will not lose money because of the positive theta. So if the market stops here or around here, this will not lose money in the short run. This will lose money in the short run. But at the end of the day, if the market is not moving but falling down or moving sideways, and if I hold on to this position until expiration, this also will create a loss because of the debit. So being able to scale out, let's say that we bought 4 contracts and from each of these strategies, and this would create an $800 maximum loss. Here is much higher maximum loss because if you move around the mouse in here, it will tell you 2,132. So it's a very different structure in terms of risk reward than this one. This has to move the market has to move to make money with this. This can move less and still be able to make money. So let's log down the two prices and we will continue monitoring these trades from now on. And the other thing that we would need to observe in here is we have a call skew, which means that calls are much more expensive than puts at the equidistant price. Right now, there is also a technical like resistance around these areas, which coincidentally matches the call resistance at 240. So these are the two spreads that I would like to compare in the next coming days. And we are looking at the January 16 again. And this is a regular butterfly, a symmetrical regular butterfly, and this is a broken wing butterfly for a very different risk-reward profile. So I will continue from here. I'm back again. It's Wednesday. I started this simulation yesterday, and as you can tell from the daily chart, the price of Amazon went above the core resistance line, the 240 line, and right now it's a little bit of a squeeze pattern on the upside. And let's compare the two positions, and I will show you what I changed since yesterday. I mean, not in terms of adjustment, but the comparability of the two positions. Right now, what you can see on the regular butterfly, it's 820 on the debit side, and I wanted to have almost the same debit here. Obviously, it's a much different risk on the upside, but I wanted to compare the two debits. That's why I increased the number to 25, because as you can tell, if I buy 25 of these $33 options, the max loss on the downside is 825. This is 820. So they are almost the same, because I wanted to compare the profitability of the strategy. Yesterday, I mentioned that if the market shoots up and goes fast, the normal regular butterfly will be much better profitable than the other one. And right now, what you can see here is that this one is around $400 in unrealized profit, and this is around $50 because the delta was much lower and much more flat. This is a positive delta, and right now, because the market moved very fast to the butterfly strikes, the delta became negative. So right now, this is a very different situation for both strategies, because this strategy wants the market to go down a little bit. This one wants the market to go up, because this is a more bullish strategy than this one. So right now they are in a very different state. And if Amazon shoots up from this, then from this price level right now, for example, to 250, then the broken wing butterfly will make a loss, and this will make a huge profit if it goes in the middle of the standard butterfly strikes. So it's very important to know ahead of choosing the right strategy that you expect the market to stay sideways, a little up, or very directional. If you want to go very directional, go with a standard butterfly. If you want to select between broken wing butterflies and standard butterflies, if you think that the market will gyrate around the level, then a broken wing butterfly can do better. Right now, the market went up the resistance line, so it can keep continuing going up. There is a confluence level of 250 and the 8.8 MurrayMath, and this is right now the second highest core wall on the upside. So let's talk about different adjustment options. One thing someone can do is scale out from this butterfly. I bought it for 205, and for example, I can scale out from two of these and at least take off some risk from the table, off the table. And as you can tell, this creates a much less risky position than previously, but it also depends on the trader what he wants to do. The other thing is, for example, you can make it more narrow, or you just roll up this leg. This leg you can roll up, for example, the whole position or part of the position. I'm going to show it to you. 240, sell the 240 and buy the 245, for example, getting a 2.6 credit for one contract. If I make it 2, 3, and 4, then this creates a negative delta. Probably I don't want to do that because the market is going up, so I don't want to be in a negative delta state. But what I could do is at least sell 2 from the 4, at least rolling up half of the position. And this creates a lower delta, obviously, but also a lower downside risk because of the premium. So right now, someone could do an adjustment like that, or just keep the position open. Or another thing that someone can do is narrowing the whole butterfly. So how to narrow the whole butterfly? I sell the 240, I buy the 245, I sell the 260 and buy the 255. This is like a normal condor order. And if I do like that, this creates a butterfly which has absolutely no risk on the downside or on the upside. Because I sold 5 strike core condors against the butterfly, and I could create a credit of 221, which means that this is higher than the 205. So that's why the whole thing becomes riskless in terms of debit. So someone could do that, or at least do part of the position for like this one. It depends. There are different options scenarios here, so I wanted to show you a couple of examples. So let's say that I adjusted the position this way, or I could do adjustment this way, or I could just scale out. Just leave out the scale out. It's very simple. I will not go with that. Let's look at the adjustment of different scenarios from now on this side. So what if I roll this up, or what if I create a condor, or like a third of the position or fourth of the position? I mean, 3/4 or the total position, but let's stick with the 2. So these are the possible adjustments someone can do in a situation like this. Here it's a much worse situation, because this is more or less at break-even point at this stage of the life cycle. What I could do is narrowing it further, which creates a very, very narrow butterfly. It's a 2.5 difference would be, because there is a 5 difference between the strikes. So if I make it narrow, that's half of it. But the other part I could do is buy back the 260, but that would create a debit. So at least buying back the 260 if I'm afraid that the market keeps continuing going up, because let's say that the primary assumption was incorrect. So what I could do is selling the 260 and buying the 255, which is obviously costing me money. And let's do it 25 times. Then this is how the position would look like. I have to pay 44 debit for each and every spread I buy. So it's more than the 33 initial risk that I put up in this position. But at least the downside or the upside risk is gone. I can do half of it. I can do 10. It depends on the trader. So it really depends on the delta and how directional I want to make this position. Right now, this is negative delta. And if I think that the market keeps continuing going higher, then I should at least roll 10. Because then that would create a more positive or balanced delta. I would say buying 15. So that in this way, I create a higher risk on this side and lower here. Because I sold some part of the 260 and bought 255. So let's track the position with this adjustment as an idea. And the other adjustment here, right now they will both have around the same actual data of the position. They have a different risk profile, but we try to keep the data around the same level. So let's see from now on how they compare going forward. I will continue from here. I'm back again. It's Thursday. Let's see what Amazon is doing. Right now, what we can see on the GEX profile is that not much has changed since yesterday. The only thing I see as a change is that the core pricing skew has increased since yesterday. So it's even more bullish, and the core gamma squeeze is playing out nicely above 240, and the next potential target is 250. And let's look around the positions without any adjustments. As you can tell, this is a much better position because it has higher delta and higher current profit state than the other one. But this is also not very bad. But the only problem I have with this broken wing butterfly is that it's negative data. Right now, if I wanted to, I could just close down the whole position if it was a real position, because it's a very nice profit in a couple of days. But if I want to hold on to this position, negative data is not good. But yesterday we did some kind of adjustments just to look around how they would behave. There was an adjustment of this that's still in a very profitable state. Or if I wanted to scale out, that's also very nice. And here we narrowed the upper part of the butterfly. And if it was the situation, so if I did the adjustment, that would be a better state because of the positive data and also still a very positive P&L unrealized profit. So if I had done both of the adjustments, let's compare the two strategies. Right now, they are both around 30, 35 positive data. So they are more bullish and they are directional. Right now, the standard butterfly has a higher profit, around 30 data, positive data, around 30 theta, and this has a much higher theta. So for example, if the market sits here, then this position will make more money because of theta, but don't be confused. It's because there is a much higher number of contracts in this position. So it's very hard to compare the two because this is 4 contracts, this is 25. So that's different. But I wanted to make it 25 so that the lower debit is kind of the same. So let's not very strictly compare theta numbers because they can be quite misleading here. The most important part is how they behave, how they look as a data position, and are they in a profitable state or not, and how we can adjust based on our opinion. Right now, I would not adjust the positions. They are in a very good state, and we are still going up to 250 as the potential gamma squeeze is playing out nicely here, and also the bullish pricing skew is increasing. So that's how the current positions look like. Let's continue from here. I'm back again. It's Friday, and let's see what Amazon is doing. It has been going up since yesterday. Yesterday, the price was around 244. Right now, it's 246. Not much happening, only a 2 points increase because after the market opened, it went down to the previous levels, and now it keeps going higher. The only difference we can see from yesterday's GEX level is that yesterday, the highest core resistance was 240. And now it moved up to 250. So it can be kind of a bullish sign if the core resistance goes higher. So I would expect that this Amazon price might reach 250 in a couple of days, but we will see. And let's compare the two strategies, how they are different. If we had done nothing since the open, this would create around $900 profit, the core butterfly. And the broken wing butterfly would be up around 960-ish. So it's a little bit above, but you know, it's a very different beast because we have 25 contracts, we have 4 contracts here. And that's because I wanted to have the same debit on the downside. But from directionality, they are a very different beast because this one has positive 50 data and this one has negative 120 data, which means that if it keeps going higher, this will create a loss every single point move of the underlying because the data is negative. So, but theta is also very positive, which means that if the market stays here, this broken wing butterfly can make a lot of money in a couple of days. This has obviously lower theta because of the contract sizes again, but I wanted to compare the same debit on the downside. So that's why it's a kind of a misleading, but I just wanted to show you how they behave differently. If you don't look at the nominal value of data, you can also see that there is a negative data because this one is curling down here and this one is going up. So if the market keeps continuing higher, this core butterfly will make even more and more money because of the positive data, and this will lose money because of the negative data. But if it stays here, The theta decay will create or move this T plus 0 line up. That's why it's making more money than here because of the contract sizes. Let's see how the two strategies would compare if I had the adjustment. Here it would be around $700 with a 37 delta because of the scale out. And this one would be around the same 9,000-ish unrealized profit. But the very big difference would be that the delta is still positive. So if you do these adjustments, for example, then it's a great thing because on the downside, you increase the risk, you can tell that. But the delta became positive. And at this moment, it's a much better position than previously, because if we think that Amazon keeps going higher, then being in a negative delta state is not a good idea. So this is how it would look if we had done the adjustments. And right now, I don't feel that I need to do any adjustment. What I could do, if I really wanted to do, is, for example, like scaling out from another part. Obviously, the price is higher because the market is going higher. So if I did this one, then I could almost take off all the risks from the table, because I would keep around $50 on the downside as loss. I would lower the delta and still have positive theta. On this side, what I could do is also like scaling out a little bit from it, like the adjusted butterfly. I can scale out from, I don't know, just let's try 10 butterflies. And then I would create a much better situation on the downside, still keeping the, it's negative delta. So I would like to, I thought it would be around flat delta, but then I need to lower it if I want to keep the positive or flat delta here. But let's say we close 10 and I stick with a small little bit negative delta, which will become positive if the market stays here next Monday. So in this case, I could create a much lower loss on the downside. Obviously on the upside, it's not nice, but still can be positive delta when the market opens next week and Amazon is not gapping up, because if it's gapping up higher, then the delta will become even more negative. If it stays here, the charm decay of delta can make the delta go around 0 or less negative than this state. But it's also, you know, it's just a choice of the trader if he wants to scale out or not, or just leave the delta as it is. But the main thing is that manage risk and adjust your delta according to your market sentiment and market opinion. That's very important for a trader to do. So as an example, let's say that I did this adjustment so that we can compare it next week. I will continue from here. I'm back again. It's Monday. Let's look around the price of Amazon. On the daily chart, you can see that the market is going higher. We are very close to the 8.8 MurrayMath level and the newly created 250 core resistance on the upside. And as you can tell, the previous core resistance was broken. It created a core gamma squeeze, and right now the current target is 250. So since my last recording, the market is climbing higher. And let's see how the positions are comparing to each other. Here you can see the positions without any adjustments. These are the original ones. And what you can see here is that they are both very healthy. The only difference between both of them is that it has still positive delta, it has still negative delta. This negative delta will change to positive in a couple of days because of the charm decay of delta. Right now the theta is pretty healthy. It's very high, still high, but they have a different contract size. We know about that. And let's see how the others adjustment would change the whole position. We have done this and this here, and on the other side we did this one and this adjustment. And I would like to show you a couple of adjustments that someone can do if actively trading the position or managing the position. For example, here last time I narrowed the whole butterfly, but only one part of the butterfly was narrowed. Right now I could do it for a higher credit like that, and this would create a situation when there is absolutely no potential loss on any side, no downside, no upside, only profitable state can be here. but the spread or the butterfly will be much narrower because it's only a $5 wide strike between those. So that's another thing that someone can do with this position. If I had done nothing, I could start doing the same thing, for example this, but like 3 times. Almost the same thing, but different approach. And on this part, what I could do is, for example, buying another 255, 260 for 44, and scale out from the other part, like that. That could also create a situation where absolutely or almost nothing is at stake because either side of the trade is below $100 loss. So with an adjustment like that, you could create something very, very nice and very healthy if someone is worried about the next coming days, because tomorrow will be CPI and the day after that on Wednesday, they will publish PPI. So these are market moving events. So if somebody is afraid of staying in the position during market moving events, that's something that is possible to do. These are adjustments that, you know, you can play around with it. You can adjust the size, and it's very important if you trade in size, at least like 4, 6, 8 contracts. There are many ways to adjust the position, a butterfly or an calendar spread, diagonal spread combination, because with size you can definitely move around the parts and create the right structure for your idea. So what if I did this, like narrowing the 260 to 55 by buying back for a debit and then trying to scale out the whole thing? Like I could do like 6 and take all the risks off the table, or I could do like 7 or 8 or 9 or 10 or whatever. It depends on the size. So let's say that right now here I limited my loss to be 300 profit. Let's say we do the same around here. So that's another possible adjustment. I will not stick to this one, but I wanted to show you different ways of adjusting the position. We will keep continuing the whole thing and how they would have behaved if I did nothing, or if I did this or that, or another adjustment. So this is another possible way before any market moving event to hedge a butterfly like that, or scale out or something like that. But later on, what we could also see is how this negative delta will change over time when charm delta decay will kick in. So there are various adjustments someone can do. Let's continue from here. I'm back again. It's Tuesday, and let's see what the Amazon has been doing since yesterday. Yesterday, what you can see on the daily chart is that the market clearly rejected the price movement on the upside on the 8-8 MurrayMath and the core resistance, the major core resistance on the upside, which was 250. And this is very important to note that if you see a very significant MurrayMath line like the 8-8 or 0-8 or 4-8, which coincides with a high core resistance or put support, then that would create, or that can create, a high reaction zone where you need to watch your positions. What we can see right now that the market rejecting the 250. So if the Amazon price is correcting, that would probably create a 240 as a target price, because there is the next call wall and also there is a technical support down here. So that would be the next major target if the market stays around here and keeps continuing down. And the other thing we have to note from yesterday, that the core pricing skew was higher yesterday. It means that the core side bullishness decreased a little bit since yesterday. And let's see how the two strategies compare. Right now, what you can see on both screens, that these are the strategies without adjustment. And on the right side, you see the broken wing butterfly, where you can see exactly what I mentioned a couple of days ago, that delta will become positive when time is ticking. So this is the charm effect of delta. So whenever there is a negative delta and the structure is usually a positive delta structure, with time it becomes positive. So right now, if I had done nothing, this would have been a positive delta position. This is also positive delta. And obviously, because of the contract size, it has a much better P&L right now with a high theta value. If we had done all the adjustments like this one, still positive, this one, nice, also profitable, this one scaling out, also nice, and this one is also nice because yesterday we made an adjustment that it should be riskless on both sides. The other one is also awesome because we scaled out from the position mostly. So right now, if I had this position, what I could do is, if I think that the market is not going higher or not clearly going higher or higher than 250 in the next couple of days, because we have the expiration on Friday and we are on a Tuesday, what I could do is create a broken wing butterfly again by, for example, just an idea, just like selling the 245 and, you know, just buying the 250 and see how it goes. I could create something like that and still be above water. So here you can see that the maximum I can make is $10 on this part. So there is no risk on the downside. So this is one thing I could do to, you know, increase the profitable part of the spread in here. Like that. If I do like 2 times, that would create another loss in here on the upside. It really depends on the trader how should position. Here I could do exactly the same, increasing this lag, and would look similar to the other one. So that's one thing I could do. But if I think that the market will go up and Amazon will reverse and test again the 250 by Friday, then I would leave it like that and would not touch it. If I had done nothing with these positions, what I could do is start the whole adjustment process now, but with different prices. For example, if I wanted to do this here, that's another price right now, 307. I did it to 228 because the market changed. So these are other adjustments if somebody did not do anything since the beginning of the position lifetime. So this is how the positions compare right now, and we have 3 days to expiration. Let's see how the market changes, but these are both profitable positions since the start. All the adjustments were great because in hindsight, we should not have adjusted anything because the market just kept continuing going higher. But, you know, hindsight trading is very easy. We need to manage the risk because that's the #1 priority. So I will continue from here. I'm back again. It's Wednesday. Let's look around on the chart of Amazon. As you can tell from the daily chart, there is a small gap down from yesterday close, and the whole market gap down. The S&P also gap down from yesterday close. And right now what we can see is that the 240 became the highest core resistance currently. This is the same core resistance line when I started the simulation a couple of days ago last week. And right now you can tell that the 250 is not the highest core resistance anymore. So the bullishness is temporarily gone from Amazon. And if you look at the core pricing skew, that also decreased from yesterday. So right now what we could see is how the market will react to 240 and this technical level around here. But the whole market is falling, so it's kind of a sentiment shift. In the short term, the put support did not change and the rest looks almost similar than yesterday. The 250 became 240 again. And let's see how the positions compare to each other. Right now what we can see is that without any adjustments, this broken wing butterfly is more forgiving because it has smaller loss than the other one. But when I checked the risk graphs at the market open at here, they were both up money. So they were both up money. You also have to know that the closer we get to expiration, the higher the gamma of a butterfly becomes. So it's more sensitive to underlying change. Right now, this is what we can see here, that a movement like that made the whole thing in a losing state because it started from yesterday and went like 246 to 238. So it's like 8 points against us. But since we showed a couple of adjustments, they are both in a profitable state after all, because this was the previous adjustments in here. These are profitable, and also on the other side as well, because if you look at all the adjustments, they made it pretty safe. So that's why it's very important to scale out from positions and also look at the GEX levels. The GEX levels will never tell you the direction. It will never tell you the future. One thing that it tells you is where are the reaction zones, and you should adjust or scale out from your position accordingly. This is what GEX tells you. And it also tells you the profile. And if we are below HVL, volatility tends to rise and the movements are exaggerated. Or if we are above HVL, the moves are a little bit more tempered and volatility is kind of less than below the HVL line. Here you can see that we are above HVL. So this move is not as fast, or usually not as fast, as it would be under the HVL line, which is right now 227.5 in terms of Amazon. So all in all, I think we have covered a lot of ideas and adjustments and thinking behind those butterflies. So I would like to end this scenario lab right in here, because there are only 2 days until expiration and all the butterflies are in a profitable state. So I hope you have learned some insights from this scenario lab recording. If you have any questions, ideas, thoughts, or comments, please feel free to ask me. Thank you for your attention. Take care. Bye. Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.